Hey Tyler, this is Umair, and welcome to our Better Tech episode. Today, we are inviting venture capitalist on our show, and we'll be excited to hear about his ideas and the context around the market environment these days. So, welcome on the show, Tyler.
Thank you for having me.
So let's kick this off by you giving us a little bit about your background, introduction, and what you're doing these days.
Yeah, I guess to go quite a bit back, I'm from Monterey, California. Went and did my undergrad work at USC where I studied business. From there, I actually worked at Creative Artists Agency for a few years, working on the motion picture side of things. And, while at CAA, worked with many of our clients to incubate businesses, and establish new ventures, and ended up going to work for one of my clients there, Danny McBride at his production company. And then from there, I had a lot of friends who were getting into technology, whether it was startups or companies like Apple, and it seemed to be a really exciting time in Silicon Valley and San Francisco. And so from CAA, I went to a couple of different startups. First, a company called Tech Validate. I was bootstrapped, and I kind of learned sales on the fly there, just learning by doing. And then from there, went to a venture-backed startup called Everstring that was backed by Lightspeed and Sequoia and a few other firms, which was a very different flavor to growth and experimentation and speed. And it was there that I got exposure to our board and venture capitalists and what they do and how they make investments. And it all seemed very interesting to me. And so I ended up going to the University of Chicago to get my MBA. Which really me trying to manufacture an inflection point and a way to double down on the idea that VC might be interesting to pursue. And then I got an internship at Bonfire Ventures the summer between my 2 years at Booth. Had a really great experience. We were deploying Fund One at the time, and just had an awesome time that summer with Jim and Mark and Brett, who was a venture partner at the time. And I was very fortunate to get an offer from them my second year at Booth, and the rest is history. So I'm going on my fourth year at Bonfire this summer, actually. And it's been great. It's been a lot of fun, an awesome learning experience, and just have had a great time, growing up with the firm.
At Creative Artists, you were in a sales role, or what kind of a role you were in?
It was representation for motion picture directors, writers, and actors. And so I think the role was actually not so different from what we're doing in venture capital, right?
Okay.
At CAA, we were working with a director and connecting them with the resources they needed to bring a motion picture to life and to bring it to audiences. So what does that mean? Connecting a director or a writer, whatever kind of talent you're starting with, right? And connecting them to an actor and financing and distribution and all the things to make this idea real and something that can have an audience and generate revenue, and have a marketing strategy behind it. When you think about what are we doing in venture capital? We're taking a founding team who is inspired and has an idea, and we're connecting them with capital. We're hopefully helping them hire. We're helping them think about an ecosystem, connecting them with partners and customers, and trying to accelerate all those things and making sure that they're making the right connections more quickly. And so I think it's actually pretty interesting, the parallels between the entertainment industry and how, a firm like CAA serves as the plumbing and the connective tissue for how things occur in venture capital. I don't think I'm the first person to draw that analogy either. I think Michael Ovitz has been on a few podcasts and stated that quite eloquently.
Right. And what is the investment thesis of Bonfire Ventures? I mean, is there any particular area where you invest? What is the size of the fund? And yeah.
So we're pretty focused. We only do B2B. We only do seed stage. We focus on leading or co-leading rounds. And then we're very low volume. We're kind of like the four pillars of Bonfire's identity. So we're on fund 3 right now. That core fund that we raised is about 165 million. And our opportunity fund's about 65 million. So about 230 in fresh capital that we started investing last year. And so, our check size is about 2 to 3 million. Some flexibility on the margins of that. But again, looking to lead and co-lead seed rounds for B2b founders that typically, have a product in market, have some early traction, have some early proof points with respect to what an early go-to-market motion might look like. And so we look for those early proof points when we're leading investments.
Okay, and I'm assuming it's B2b Saas or other stuff as well.
B2b Saas is one sliver of what we do. We have done, I would say, like broadly, we invest in B2B technology. Some of that is technology with some kind of a services component.
Okay.
You often see those kinds of models in logistics and supply chain, where the business is some marriage of a services component and technology. We've invested in fintech and businesses where payments and GMV is the primary driver of the business model. Consumption business models, API-based businesses. And so, B2B SaaS is a lot of what we do, but it's not all of what we do. And it's one business model that can drive, B2B technology and adoption.
Okay. And so has you, by the way, any exits so far from your fund 1, or what are some of the well-known names? Are there any particular names or startups which you would like to mention over here where you have invested?
So I'm sorry, what was the question?
So I'm saying any big name startups or where you have invested so far, if you can throw some names.
Yeah.
The kind of company.
So in Fund 1, we're investors, in a company called, I don't know how large they are, relative to what large really is. If you look at, public companies and companies of some real serious scale, but, in Fund 1, we're investors in a company called Figment, that is building some pretty important infrastructure for the crypto and Web3 space, which is obviously a little challenged right now, but building some pretty interesting technology there. Investors in a company called Speckit, which again is growing, but still small relative to companies of real serious scale. And so I think that in Fund 1, we're seeing a lot of companies start to blossom and grow well, but it's quite early.
So given the current environment around startups and the lack of funding, or probably VCs are a bit hesitant in funding startups, how you have seen the change or the shift is happening? What has changed in your opinion from, let's say, 2 years back to now, and how you see the market going forward?
Yeah, I think that there's much more emphasis on, the fundamentals of a business. Their focus on problems that are mission critical, their ability to deliver solutions that really solve for those needs. And so I think there's just a distillation and a focus on what are the core problems that need to be solved across enterprises and businesses and the core jobs to be done. And how are you able to deliver a solution effectively and efficiently? And then there's a lot of other kind of metrics and observations that go into that, right? And so, metrics like CAC and CAC payback and cash efficiency, I think, are becoming really, really important, right? Because while in some cases they can be blunt tools, they are at least starting points for conversations to understand how does your business consume capital? How do you go to market? How much market pool is there? And how much of the motion do you have to kind of augment or force with capital? And so I think just right now, and I think it's something that'll probably persist for a while, and maybe, for the foreseeable future, because companies need to be able to, solve critical business needs and distribute their products in a way that's efficient and that's scalable. And so that seems to be where the focus is. And I think rightfully so, because those are the businesses that really should be around and that should continue to receive funding.
So have you seen your funding velocity or the number of investments you make every quarter, every year has gone down significantly, or it's about the same, or you're just backing your existing ventures? How it's happening for you?
We continue to be active. I think that in the aggregate, if you look at the market, it's clear that there's been a slowdown. There are less financings happening. But us personally, we as a firm, we continue to be active. And I think our observation is that there's a slowdown across the market. And so founders and operators need to, I think the horse has been beaten maybe a little dead, that, like whatever capital that you have should act as if it's the last capital you're ever going to receive. But I think it's becoming clear that capital is less available. There is a slowdown. Investors are, taking longer to do due diligence. They're taking longer to run processes. There is, more value to optionality kind of right now while the market shakes out, and firms get a sense for like what is happening and, how they should be deploying capital. And so, I think that capital is just less available right now. And so, there is a bit of a slowdown. But I think every firm continues to be active, right? Like we have to deploy this capital. And even though in their aggregate, we may be saying, and other firms may be saying, there's a lot of transition happening right now, and the market's very dynamic and a little volatile. And because of that, we are apprehensive, or we're going to slow down a little bit on an opportunity by opportunity basis. If an investor is able to build conviction and identify with a problem that he believes needs to be solved in the world, and a solution that can solve it elegantly, and again, reach a user, reach a business in a way that is efficient, an investor is going to want to make that investment, right? And so I think, like in the aggregate, yes, like you need to behave as if capital is less available, and the firms have slowed down, and financings have slowed down. But we're still making investments, and great companies are still being built.
So have you seen any kind of change in the definition of, you mentioned that you invest a lot at the seed stage. So have you seen any change in the definition of what is really seed? I mean, both in terms of the size of the check as well as the stage. I mean, now at seed, are you already looking at if the company has find somewhat a product market fit, or they have already started generating revenue? I mean, the definition of seed. What is your definition of seed these days, and has it moved or not?
We have stayed pretty constant in terms of like what we do and what seed means for us. And we've done our best to remain pretty disciplined on that. And so, for us, that's a $2 to $3 million check. So we're usually leading a $3 to $5 million seed round. We're targeting about 10 to 15% equity there. There's a product in market. There's usually early revenue, an early group of customers that reflect the ICP, so we can have a conversation around why that ICP, why do they have a certain pain? Why is there a certain amount of urgency around it? What are they looking for in a solution? What are the first things that you're solving with respect to the broader problem? And so like that is what kind of seed means for us. It's different for every firm, and seed has always been kind of a nebulous phase.
Yeah.
And so I think it's worth defining, and founders should have those candid conversations with seed investors when they're looking to raise those rounds. Now, zooming out from that, I think that it's pretty clear that the goalposts for what it takes to, reliably kick off a successful Series A process, those goalposts have been moved out a bit. Like what we're seeing is, ARR or annualized revenue really needs to be at least 1.5 million or so. And I think 2 million is much safer territory. And so part of what you need to do is reverse engineer and think, like, what does that mean for seed investing and seed stage companies? And if you think of a seed round as, like, let's say a $3 to $4 million round, just for the sake of simplicity and for this conversation, taking that capital goal and investing in a way where you can grow from 0 or 50K in ARR, or even 100 or 200K in ARR to, 2 million in ARR, that's really hard. There's a lot of process and just discovery of the customer problem and how to articulate it and how to evangelize that problem, how to map that to your solution, an onboarding motion, a renewal motion. There's just so much that hasn't been built yet. And you're really forcing capital down the throat of the company when you're still figuring out, like, where that capital needs to go, right? The body isn't, like, fully functioning yet. And you have, like, all this blood trying to flow to different areas that aren't even built yet. It's a terrible metaphor. But
it's actually good, but it's a pretty good analogy, actually.
Yeah. So this is all a long-winded way of saying, like, what we're seeing, like, what is seed now? Like, what are we seeing? It seems to be closer to, like, 500K in ARR, I would say, is, like, the average kind of traction that we see. We've also led seed rounds for companies that are much closer to $1 million or over $1 million in ARR. And so every opportunity, again, like, every opportunity is different, right? And I will say that I think that at this stage, the absolute number of revenue is, again, a little bit of a blunt tool for, like, measuring, like, where is a company in its life cycle, and are they ready for a seed investment, and are they ready to kind of figure out this journey from our perspective from seed to A. But really, like, it's kind of a derivative heuristic, because what is it taking to get to 500K in ARR? Well, they've had to generate a lot of pipeline to get there. And at first it probably wasn't very predictable, but now it's probably a lot more predictable, ideally. And at that point, they may have gone through some renewal cycles. And at that point, they may be on, some second or third iteration of the initial problem that they were trying to solve, and what the solution needs to be to fully address that problem. And they probably have, because they figured out a way to generate pipeline in a way that's hopefully relatively predictable, they probably have a thesis and a point of view on, like, what the best marketing channels are, or sales channels, and what that looks like. And so there's this entire area under the curve of experience that is produced in getting to a certain point. And I think, at least from our perspective, it's a lot more about that. There is certainly, like, the absolute number, and it's like, okay, like, can this company triple or 4x from this point to get to what we think it's going to take to raise a good Series A? And also, along that journey, build all of the fundamentals that will help them grow from 2 million or a Series A onward. The priority is to build a balanced business. And so there is still that absolute number that's important, I think, in that proximity to what a good Series A is. But I do think, more importantly, there's all that learning that takes place to get there. And being able to unpack that through the diligence process when we kind of begin our relationship in some ways with a founder is really important to us, and I think ends up being beneficial to the founders as well. So that was a very long-winded answer, but that's kind of
I think
what seed means for us, and then kind of what we're observing about how seed is kind of dynamic right now.
Yeah, and then I'm looking for a shorter answer. So I was talking to a CTO, and I said, you put AI in front of the startup name these days, and your chances of getting funding actually grows, like, by a multiple. Is this a correct statement?
Say that again.
I'm saying, I was talking to a CTO, and he said you put AI in front of your startup name, and your chances of getting a funding goes by double these days. Is this a correct statement?
I mean, obviously, there's a lot of excitement around AI.
Yeah.
I think that, like, we're now aware that we're reaching a fever pitch here. And I think there's self-awareness is starting to take hold a little bit. Obviously, there's still a lot of excitement that's well-founded, right? Like there's a lot that AI is capable of. It's proving to really be a great solution for a lot of problems and jobs to be done. And I think there's a lot of upside that can be created, right? Not necessarily problems to be solved, but just like new surface area for upside and things that companies previously did not even think was possible. But we are like, I'll just give you our point of view. Like we're very focused on software solving critical business problems. Like when I start conversations with founders and they want to jump into the solution and the product, I'm always like, let's talk about you first. I want to hear why you left whatever company that you were very comfortable at and much safer at to go and start this hellish journey building a startup. But also, like, what problem did you see in the world that compelled you to make this jump and this choice into a lifestyle that's a lot more challenging and a lot more lonely, and is undesirable in a lot of ways, but also very exciting?
Right.
Like, what are the problems that you solve, and like why, and who else cares about that, and why do they care about that, and what's the impact of that business? What's the impact of their personal life? And I think like really getting into the weeds on that is a great place to start. Not just in the journey of as an investor, understanding a business and like how does the world need the solution now, but I think in terms of understanding like AI's place in the world in different B2B worlds, right? Different industries, based on that particular user and the particular problem. Does AI need to solve every problem? Is enough lift created, enough efficiency created? What is the bar for trust? Does AI need to be 80% right or 90% right? What's good enough? And so, again, I think this is not like a unique point of view at all, but I think, AI is a tool, right? It's a very powerful tool, and there's an opportunity for it to really permeate every element of a business or a software solution. But it still comes down to what are the set of problems that you want to solve, and how are you thinking about mapping the solution that you're trying to build to those problems? What does that scaffolding look like, and how can you hang AI on it? And where do you prioritize hanging it there? And so very excited. We've invested in AI companies. We're looking at AI companies. We've been investing in AI companies before this hype cycle. And so it's something that we've always been very excited about. And I think the advancements in the last several months have been incredible.
Right.
So it's a very exciting time, but I still think as a founder, you need to maintain some discipline, and we as investors need to maintain some discipline in terms of what are the real durable problems to go solve, and who should be solving those? Are they the platforms and the incumbents that already exist? Or where are the white spaces where new companies should be built to go and solve these problems, because they're going to be able to solve it better than anyone else?
Right. Last two questions anyway. I want to give a quick answer. Any particular critical area that you feel it's still pretty green, and if we can go and solve their problem, they'll be really doing something which is of interest to you? That's one question. And any last quick piece of advice to entrepreneurs trying to raise money these days?
Yeah, I'll start with the latter. In terms of advice to founders trying to raise money, I think it's being laser focused on a problem, and why that is a hair on fire priority, and how you intend to drive urgency around that problem to be solved. And I think it's this starting with that kernel, right? Why this is an important problem. And then from there, building out, but remaining really focused on, and again, my lens is like seed stage. And so that's what I'm going to provide advice on. But building out to, there's this initial problem. Who has this problem? What does that person look like? What does that business look like? And so now we're a problem, ICP. What does that first motion look like? How are we going to reach them in a way that is efficient? Where are they looking for these solutions to these problems? Where are they joining community? Where are they going to trade shows if that's a part of it? And figuring out just with rigorous focus, what is that first problem for that first person and or business? And what is that first motion to get this solution in front of them? And so I think just thinking through that framework and making sure that you're not biting off too much too soon. And then I think mapping that to like where you want the business to be, right? Like, why does this problem matter even more in 5 years, 7 years, 10 years? And how does this solution evolve in that time? And I think important to convey is to your investor is this understanding of like where the world's going, but how do you reverse engineer that into, the smaller, more tactical steps that you can take this year? I think that is the most important thing to be really clear on. And then in terms of, markets that we're excited about, I don't know if you'd call it like green space or open ocean anymore, but we're still super excited about vertical software. I think there's still tons of industries that do not have purpose-built solutions, that are forcing squares into circles, trying to bend horizontal platforms. Oftentimes they're very old to their will. And there's just a lot of opportunity, unique workflows, unique opportunities to collect data, and just, incredible nuance that seems trivial, but actually has a massive impact on businesses and their ability to run really well. And so vertical software is an area that we continue to be really excited about. And, there's some well-documented, advantages to focusing on verticals in terms of efficiency. And we also think the applications for artificial intelligence in those industries are really quite compelling because you're getting at, unique workflows and unique ways of approaching problems that on the surface seem, common or homogenous across different industries, but there's a lot of nuance, right? So if you can build those unique workflows, if you can get at that unique data, if you can create and manufacture those new insights, there's a lot of really exciting opportunities for intelligence and automation there as well. So that's one area that we're excited about.
Well, thank you very much, Tyler. I think we have approached our 30 minutes, but it's a great talk. I mean, hearing directly from a VC that how they are looking at the space these days and what are their investment theses and where getting some advice from there is really, really very valuable. So thank you very much for being on our show. I think the advice and the conversation was wonderful, and hopefully people will enjoy it and they'll get some meaningful, they'll get some real value out of it. So thank you very much.
Yeah, I really enjoyed the time. Great to meet you.